All right, so today I wanted to make a video on WRB. This is WR Berkeley. They're an insurance company. I've talked about them before, but it's been a while, so I wanted to get into it a little bit more again. First things first, if you get value, please like, subscribe, comment. Really appreciate all that. So getting right into it, they have a $21.84 billion market cap, so smaller on the large cap end. 0.55% dividend yield, which is fairly low, but I think that's a good thing in a way, which I'll get into. Earnings yield 7.22%. I wish that was a little bit higher, but they're only paying out less than 10% of that towards the dividend. So they got lots of room to buy back shares, lots of room to grow the dividend, and lots of room to grow the company. So that I really like that. Getting right into the insights here, operating margin just under 20%, net margin just under 12%. Those are decent. They're not amazing by any means, but they're still good. I'm not concerned about that by any means. They are growing well. Financial health is really good. They're buying back shares. Next year projected to grow earnings just over 12%, revenue just under 13%. That's good news. The dividend I'll get into. If we look at analysts, the average analyst has price target $66.45, which is about 13% above where it currently trades. The lowest is actually just 3% less. So at least according to analysts, they definitely agree that the stock is cheap. So let's get into the metrics and the income statement here. If we look at its revenue, revenue was actually pretty much flat from like 2014 to 2020. And ever since then, I mean, they've gone from, second quarter 2020, 1.94 billion to 3.4, third quarter 2024. So whatever that would be, 4 years, they almost doubled their revenue, which is good to see. If we look at the shares outstanding, this number has continuously trended down ever since 2019. They've gone down pretty much every single quarter, which is good to see. If we look at earnings are actually down a little bit from the highs, but they still are trending up. And it looks like there was a quarter first or second quarter of 2020 where they were basically actually slightly negative. So that was a little concerning, but ever since then they've grown extremely well. If you look at earnings per share, which is obviously the most likely or the most important metric, that number is also near a high. It looks like the highest at least recently was that first quarter of last year, but they are still doing good there. Looking at their metrics, operating margin, again, if we look at the operating margin, this number is basically it looks like it is at an all-time high, at least a decade high. If we go back to 2004, actually it looks like pre-financial crisis, it was higher at just over 21, but it is the highest it's been ever since the financial crisis, at least as far as their operating margin, which is also very good to see. They are expanding that, which is exactly what you want to see. Net margin, probably a similar story, I'm guessing. Actually, yes. So 13, just under 14 was the high back in 2007. It actually was a little higher first quarter 2022, but it is very close to that 15-year high roughly. So also a good story there. If we look at return on equity, return on invested capital, these numbers look like they've been very steady ever since 2021, 2022. The lowest they've gotten is 15.6, which is very good. If we look at return on invested capital, this number is actually basically at an all-time high. The last 2 quarters have been the highest they've been in a long time. They were higher back in 07 and 06, it looks like, but that's still besides the point. The highest they've been since then, that's also very good. And then if we look at the last thing here, revenue per share, consistently pretty much every quarter it is going up. So that's also exactly what we like to see, because if they're growing revenue and their profitability metrics are at decade highs, that's nothing but good news. So if we look at the dividend, they're actually growing it a little faster than they historically have, which is exactly what I like to see. Over the 10-year period, it's about 9.4. Over the 5-year, it's about 10.3. And over the last 3 years, it's about 11.4. And like I mentioned at the start of the video, their payout ratio is below 10%. So that's exactly what I like to see. A company that is growing their dividend, 10, 15% per year for a decade or two, you're better off owning them than a company that has like a 6, 7% dividend and just isn't going to be able to grow it. Because if you go back, if we go back to, pre-2000, the highest their dividends ever gotten is about 6%, it looks like, but 0.5% is their current dividend. If we go back, 5 years, it's over 1%. If we go back 10 years, it's a little over 2.5. So that's what I like to see. I prefer that because that still gives the business room to grow. That gives them a chance to buy back shares. That's dividend. I've said it time and time again that dividend growth is better than high dividends. At least if your goal is, hey, I want to invest for the next 20 or 30 years. If you want money now, okay, I can understand that. But if you want money 20 years from now, 30 years from now, even 10 debatably, you want companies that are growing their dividend, that have dividends, below 2 or 3%, and have room to grow that. So let's get into the valuation here, just because I think that that's the real question, is that I think it's a good company, but is it a fair value? So if we look at their earnings, going back about 10 years, they've grown their earnings 21% per year. Their average PE is about 16.7. They're currently at 14.15. And then they've grown revenue about 11% per year. They've actually grown their return on invested capital very nice as well. So let's get into the valuation just to try and figure that out here. So I'm projecting them to grow earnings 10% per year, which is less than what they've done historically and less than what they're projected to do. I'm projecting them to buy back 2% of shares per year, grow the dividend 8% per year, which is less than the 3-year, the 5-year, or the last 10 years. They're going to trade at a 15 PE and discount ratio 10%. So that implies that fair value is 32% above where it currently is, and it's going to grow at about 13% per year. That might be a little bit aggressive. You can possibly argue that, but at the end of the day, I still think that this business is undervalued, because this is a business that is growing. Historically, it's grown faster than the S&P, at least as far as earnings goes. They're projected to grow roughly as fast as the S&P over the next 5 to 10 years. And yet they're trading at like a 25%, 30% discount to the S&P, which is roughly why I come to this number. Again, when you see these numbers, someone might think, oh, it's a 30% discount. Keep in mind, I'm projecting 10 years down the road as well. So there's nothing saying that the stock goes absolutely nowhere over the next year, 2 years, 3 years. That very well could happen. And not to mention, too, these are just well-educated guesses. These are calculations based on metrics. We could have a black swan. Like, many things could happen that could completely derail this. We're simply playing the odds here. These are just the odds. Obviously, we could be wrong. So I am definitely buying this right now. If I were to choose like 10 companies and I could only buy 10 companies over the next 6 months or a year, this almost certainly would be one of them. Honestly, there's a lot of insurance companies that I like. I've talked about HIG as one. This one, obviously, KNSL, after its recent pullback, I really like them as well. And then Primerica as well. Primerica is a little bit higher, at least as far as their 52-week high, 52-week low, but I still think they're undervalued as well. The best of the best insurance companies are very, very good investments because they're cash cows. I mean, they have guaranteed income coming in and limited downside, like limited downside. So they're kind of like the Visas and the MasterCards of the world, in that they make money very easily, right? And not only that too, with yields being higher right now, at least in the States, they typically invest a lot of their premiums into short-term treasuries, because they potentially need that money for payouts. So, and with rates being higher, that just means they're making even more money than they traditionally have over the last decade on that. So I like them. I'm definitely buying them right now. Doesn't necessarily mean that you're going to make a whole bunch of money, because when it comes to insurance companies, I don't think they're necessarily your get-rich-quick kind of stocks. They're your get-rich-slowly kind of stocks, which are the exact ones that I really like. And like I mentioned here also, that this company's also outperformed the S&P rather easily over the last decade and over the last 5 years, it looks like, as well. Let's see. No, they're almost exactly the same as the S&P over the last 5 years. So still, over the long run, they have outperformed. Right? Over the long run, they have outperformed. I mean, this is going back to, when is this going back to? This is going back actually almost exactly 5 years, and they have outperformed the S&P over that time, by 20%. So, like I said, I think that this is a company that will outperform the S&P, and they're trading significantly cheaper, which kind of, implies that there's less risk, which I think there is. Not that there isn't risk, because there always is with stocks, but I think that there's less risk here, which is why I think it's such a no-brainer. So anyway, that's what I wanted to bring up today. If you liked the video, if you got value, like I said, please like, subscribe, comment, and stay tuned for more.